If you ever get the chance to speak to an old school Dalal Street veteran and ask them about whether you should be a trader or an investor, chances are that they will tell you that you should choose to be one or the other. And the reason that they say this is that there are very few who have managed to do both simultaneously successfully. Of course, the scale of the people that do so is something that you and me cannot even imagine. I'm talking about the likes of Rakesh Jhunjhunwala. There's something about a successful trade that gets the blood pumping, is what I've been told. You've made the right call about a stock before anyone else has spotted it, but in the life of a trader, that rush can very easily turn into a painful loss. This is Money-Wise on NDTV Profit, and I'm Mathew. On this episode, I'd like to give you a sense of what it takes to be a successful trader. Joining me today is Kush Bohra, capital market professional, SEBI-registered investment advisor. Kush, thanks so much for taking the time.
Hi, Alex. It's such a lovely evening to be here with you on this show.
Absolutely. So, the reason that I'm speaking to you today is I want people to learn from your experiences, and I want them to get a sense of, well, not necessarily the do's and don'ts, because there's not necessarily a line or a list that they can follow that will give them the exact secret sauce to being a successful trader, but hopefully they'll learn through this conversation. First, let's set the context. How long have you been trading for, and what drew you to trading in the market?
So, Alex, I think much like most people who start their journeys, it's actually in the family. So I come from a family of people who've been into investing and trading for a while now, having spent Diwalis in the Bombay Stock Exchange building, and having started trading and investing fairly early, right after my 10th standard. I think somewhere when I entered college, I started trading or investing. So it's been a while, and it's mostly the environment that actually got me to the door. But the rush of trading and investing and spotting the markets and spotting a stock, and then it eventually evolved into actually helping other people grow their wealth, and hence the SEBI registered investment advisory and all of those. But it's the environment and then the evolution of the idea as to not just for yourself, but for others as well. That's what got me into this space.
Okay, so give me a sense of how the progression went in terms of the time that you've spent. Initially, of course, you would have had to deal with college and various other things and the things that young people do. How much time were you giving to the market at that point? Has that gone up over the course of the last several years?
Of course it has. And, from the sense that back in college, it was more of a side thing. You're learning, and to be completely honest with you, why did we do most of the things that we did in college? Is because to get a heavy sort of a resume for either an MBA school or our first job, right? So this was something on the side. We always thought it'll look very cool that, oh, you've done graduation, but you've also done a stock market NISM course along the way, right?
Sure.
So, and that's how it started. So at that time, it was more of a learning experience along the side,
It wasn't to earn the pocket money?
Wasn't, because it was dad's money, dad's account, and the money was going back into his, right? So his account. So it wasn't mainly for that. It was mainly for getting an idea into what this beast is that my family's always been into, right? So get a hands-on experience of that fairly early. Now, being a capital market professional, the amount of hours that go into it are significantly higher.
You can't draw the line at some number of hours that is required.
That's the beauty and the bane of it. Is that when you're in the markets, I mean, even at 5 p.m., if there's a global news, right, you just, the first thing that you do is first go and see the news, and the second thing you do is see what the SGX Nifty is doing after that, right? So while you do have hours, right, in terms of the market hours, and maybe then some, preparing for the next day, but it's still like an ongoing thing. Most of our discussions, your friends, your colleagues, when you're just playing squash or working out in the gym, the conversations are always on.
Yeah, you usually surround yourself with people that have the similar philosophy to life, right? But speaking of that philosophy, I'm guessing that over a period of time that has crystallized for you. It is still something that is evolving for everybody. But having said that, what is the journey that got us to this point for you? What does that philosophy tell you right now about trading and investing in the stock market?
So I'm glad you mentioned one thing, which is the philosophy is a continuously evolving one. And I've come to realize that, this is going to remain. The more number of interactions you have, with people, the more things you learn and read, the more instruments you come across, everything gives you that extra idea, that new idea as to how you could do things differently this time around. So it took a while for me to get to the philosophy that I'm at today. But started off as a trader, became an investor, then realized that, why not a bit of both, correct? Having spent some time in the market, having learned about how some of these instruments work. So that's how the progression, the journey began. If I were to put that into words, very simply, I would call it objective-based investing.
Okay.
And the reason for that is, horses for courses. You've got so many instruments out there, so many financial instruments out there. And as human beings, we've got so many needs, right? Even if we talk about just the financial needs, right? We won't go too deep into mutual funds and insurance, right? But even if you stick to the equity side of things, you've got long-term portfolios that you can create. You've got short-term portfolios. You've got derivatives now, right? You've got trading bets that you can take. So these are instruments that you can play around with depending on your objectives.
Okay.
So basis that, my portfolio is constructed just like that. I've got a long-term portfolio. So just for example, right, the day my kid was born, we created a joint account for him and we've started investing for him. Now, that is something that's taking care of its own, right? I mean, as the markets grow. So that is an objective-based investment. When he's 22, 24, he'll have enough and more capital for him to play around and do whatever he wants to with it.
Yeah.
Then there is the trading portfolio. So it's more objective-based.
Okay, so you mentioned that you invest and trade and you have objective-based investments, right? And this is similar, I think, to the strategy that is spoken about on this platform, on this show, as well as various other shows that we've done, where you say that you identify your goal first, what you need to achieve over a period of time, and then you use the vehicle accordingly, right? So it's pretty straightforward. But I'm captivated by the idea that you both trade and invest. Is that easy to do? Or is that something that you've had to work at? And what are the kind of mistakes that you made along the way?
I've had plenty of those along the way, right? But that's how you learn. So let me first talk about the idea that can you invest and trade both? My idea is not only can you must.
Why?
The reason's very simple. See, as we discussed the objective-based part of it, right? What does investing do? If you look at the biggest names, right, in the world of investing, whoever's made money, hands down, most of those names, right, 9 out of 10, or maybe in fact, 95 out of 100, if I can put it that way, have been investors. So that is empirically very clear that, long-term investing makes you wealth. Right?
Yes.
Trading also has an objective, which is, of course, it is to make money first. But what happens is that if you allocate a very small portion of your portfolio to trading, it allows you to stay connected with the markets, unlike what investing does. If you're a long-term investor, even a medium-term investor, you buy, forget. You might not want to be too actively involved, right? But if you want to stay abreast of whatever is happening, if you want to stay involved, that is where trading comes in. Now, mind you, I'm not saying that, that should be your primary objective. As long as money is involved, making money from that money should be your primary objective. But trading, as you will also realize and recognize, is that it keeps you in touch, very well connected, and that in turn might just give you some ideas about the long-term portfolio as well, right?
Yeah.
So hence a very small portion, but
how do you define that small portion?
So typically, if you go by the rules of portfolio sizing, no position in your portfolio should be big enough that you incur a loss more than 2%.
Of your overall portfolio.
Of your overall portfolio. So why not have a trading portfolio which is just about 2, maybe about 3%, right? Even if you, statistically lose all of it, it's just a small portion of it, right? You may not end up losing all of it, right? Depending on the instruments that you dabble into. But a 2 to 3% of allocation towards trading is not a bad idea.
And one would think that as your size of your portfolio grows, so too does your ability and the quantum that you have available for you to trade. Does that make a big difference?
Well, it does, but ideally it should not. It becomes very difficult to stick to these numbers, because trading being the animal or the beast it is, right? See, making money is more behavioral than technical, or maybe 50-50 of each. The moment you get a few more winners, right, you get a little more excited, and the 2% might end up being 20, maybe 50, who knows? That's the check and the balance that you have to keep in place.
Can you really do anything with 2 to 3%? People starting out, and I'm sure a lot of people start out with really small portfolios, and they'll probably be asking, hey, you know what? I'm not going to take anything home with this.
So this is where one-on-one advice helps a lot more.
Sure.
Right? if people start out with a small portion, all the more reason for them to have a much smaller allocation, maybe not 2 to 3%, right? If someone's starting with a lakh of a rupee, for example, right? They may feel that 2 to 3% is not really that big a number.
Exactly why I'm asking.
Do anything with. Maybe you could bump it up a little, but not beyond a point where if you end up losing all of it. See, the rule of thumb is that if you make a trading loss, you should not lose your night's sleep.
Yes.
Now, while this is a very generic thing, right, and where the 2 to 3% rule might not apply, that's where you have to find your sweet balance.
Okay. So let's talk about some of the mistakes, because ultimately, I think through these stories, people will either relate to mistakes that they, because what I've noticed is, especially when I've spoken to traders, is that often they speak about the successes that they have and they won't speak about the losses. And the SEBI data itself that came out not too long back pointed out that most retail traders are losing money.
Yeah.
The guys that are actually making money are the prop traders, the algo-based traders, right? So tell me about some of the losses and what they taught you.
Sure. So I don't think the SEBI data is really as surprising, even if you take a dipstick survey, right?
Yeah.
So that's true. It makes a lot of sense. And I am also guilty of, perhaps dabbling a little more, into derivatives at one point in time.
Yeah, sorry, that qualification needs to be made, because that SEBI data talks specifically about trading derivatives, but you can also trade in the cash market.
Yeah, but I think that, as you said, that mainly applies to derivatives trading. So a couple of, mistakes that, I really wouldn't mind admitting. One is that, as I told you, I started out very early, right? So this was back in college, I think early when we started our first job. And by our, I mean, me and a friend of mine, we thought, if the markets are doing so well and if you can make such handsome returns, why not take a loan and then dabble? Correct?
Okay.
Yeah, and I'm so glad that we did that way early in our career, because that kind of risk is something that we could absorb and we can laugh about and discuss today as a learning experience. That's the first and the only time.
What is the quantum of the loan?
About a lakh or so.
Okay.
About a lakh or so. And I remember this because maybe I had just started my career. I was about to, but a friend of mine was already doing it. So he could, he could avail a personal loan. I couldn't at that time, right?
So he took the loan.
So he took the loan.
Right.
And me already being into the field of investments, why not do a joint venture kind of a thing?
Yeah.
So that's how it started. And as I said, that's the first and the last time I've ever done that.
Yeah.
Ever. And that's a genuine advice or input I would give to anyone listening to me right now. Don't do that.
Complete the story. What happened?
How do you think that story would have ended,
I want to hear it. I want to hear it. What happened?
Of course, we lost the money in the stock. We ended up paying the EMI and the personal loan off through our incomes.
Right.
Correct? And that's how most of these stories end, Alex.
Yeah.
Right? See, the idea is that the EMI is going to hit your account every month. Correct? 8, 9, 10%, what have you,
And so
depending
you need to
on.
make more than that.
That is one. The most important bit is the consistency. Let's say you hold on to an account, personal loan for a year or two, maybe 3, correct? Markets don't perform in that year. The year you close your loan out, correct, for such a need, and then the next year markets perform, or forget that, the next month the markets perform. So that's the biggest challenge. Do not take loans or leverages for investing or trading into markets, no matter how lucrative it sounds. And in the last 3 to 4 years, when the markets have been super, right, especially the mid and small cap, I think there have been enough and more instances where people have done that. And now I think the reality is starting to kick in.
Certainly. So you've spoken about one very important mistake that you learned from.
Yeah.
What about trades that you've made that have, maybe you have been a little greedy about a certain stock that you saw about, or a certain trade that you thought, there's no way that this can go wrong, and it went wrong?
Oh, yes. I mean, again, had a fair share of those as well. I wouldn't name stocks right now. But yes, so again, when I started out, I was in the derivatives department, of the company that I had joined. And it seemed very exciting, like it does to anyone who hears about derivatives first up, right? I mean, it's only even the first 3, 6, 12 months that you get a reality check. And when we started out, it was the same thing, that the opportunity or the possibility is way, way better than the probability. The probability of you making a big buck and, especially consistently, is minimal, especially in derivatives trading. So that's where we got sucked in. That, okay, why not dabble into derivatives, do a few more trades? not only was it stocks, it was also the index.
Yeah.
Nifty back in the day, bank Nifty came in a little later. So that's the other thing we were guilty of, which is, or rather I was guilty of, which is dabbling too much into derivatives back in the day.
Realistically,
Yeah.
can you make how do I say this? Can you build wealth trading derivatives realistically?
So I'm going to qualify that answer, right? My answer is a yes and a no. You can't make money trading derivatives, right? The way most retail traders, I'm assuming, do, which is compulsive trading, which is hope trading, which is any weak system or format that they might have, and then hope that they'll perhaps end up making big bucks. That is very, very minuscule probability, as the SEBI data itself has shown. However, I also know the other side of the table, which is, as you said, prop guys, ultra HNIs. There are these smart traders who've learned in depth what derivatives are and how are you actually supposed to use them, and then make a business out of it.
Okay.
It's not something that you dabble with and hope to make big money. So yes and a no. Yes, for those guys who've learned this and who've made this their full-time jobs and careers, and put in risk management systems in place, put in those trading techniques in place, and that's when you can make this a profession. On the side, not too sure.
How important is a stop loss?
I think stop loss is God's gift to mankind.
Okay. Can you qualify that?
Look, when you enter a share, correct, what is it that is really in your hands? Every trade or every investment that you make is obviously with the hope that the share will go up and you'll make money out of it, right? Whether it happens or not is not in your hands.
Yeah.
The only thing that is in your hands once you've made the investment is when you want to come out of it. The biggest question, so I've been conducting training sessions and also, a lot of these, especially in the past, and the biggest question that we had, even bigger than कौन सा stock buy करना चाहिए, आज क्या चलेगा, the biggest question was, when do we exit?
Yes.
Both on the upside and on the downside. So my question, my answer to that is, you decide your destination before you sit in the car and not after, right?
Yeah.
So once you're in the car, you know where you want to go, and that's when you get down. Same thing applies for a trade. When you're in a trade or an investment, you should know your targets and your stop losses. You could revise them along the way, but you should know them before you get into the trade. Now, if the stock is not performing, correct, hope is a very bad strategy.
Yeah.
You buy something at 100, it goes to 90. If you didn't have a stop loss in mind, you might end up waiting all the way up until 10.
A lot of people have gotten into technical analysis and all of those other aspects. They watch the programs that we have earlier on in the day. But the question is, if you don't have that ability, and if you're buying for the long term, right? You mentioned that this is a strategy that is applicable both for a trade as well as for an investment. How do you determine when the bottom has been hit, and how do you determine when to start averaging on the upside? Because you don't know what the bottom is.
So, Alex, not very clear answers to this. And the reason I say that is because stocks will behave very differently. The portfolio horizons will be very different, all of those things. But just let me stick to my strength, right? Technical analysis is something that, we talk about a lot, and that's my forte, right? When you do technical analysis, when you've got a system in place, right, you can see certain aspects which tell you that maybe the stock is now attempting a rebound. Just to give you an example, right? There are something called positive divergences.
Yes.
When you see the stock fall, but the strength indicators are not falling as much. In fact, they're rising a bit. That's one indicator that perhaps the bottom is in place.
Your relative strength indicator.
Absolutely,
right.
spot on.
Sure.
So what happens there is that you get an idea. Of course, the stock could go from 90 to 95 and then again fall back to an 80, but you've given yourself an opportunity to start averaging on the way up, maybe once you've crossed the 100 limit as well.
So you find those indicators for you, whatever those are.
Yes.
You can do perhaps a little bit of reading, a little bit of study to identify what works for you and what fits your philosophy. And you use those indicators to tell you when it's on the upside. The other aspect that I want to talk about is, how do you limit your mistakes? Because what I've also heard, and I started the program talking about these Dalal Street veterans, is often they speak about one, time spent in the market rather than sitting on the sidelines. Two, they speak about limiting the number of mistakes when you are trading. And when you limit the number of mistakes and bring it down from 6 out of 10 to 3 out of 10, which is very, very hard to do, you are then more likely to succeed than not.
So, allow me to alter that question itself a little, right? It's not the number of mistakes, Alex, that you're reducing. It is the impact of those mistakes.
Okay.
Right? So, time and again, I've discussed this idea is that if you want to make money in the markets, and just let me throw a question at you, right? If you want to make money in the markets, if you divide your capital equally into 10 stocks, how many of those do you really want to perform for you to make money in them?
At least half of them.
I would say even if one of those ideas makes a bumper hit.
Sure, and we're talking about 4-baggers and
absolutely.
all that, right?
And if I take a risk-reward ratio of 1:2, correct? Do you know what that number comes to? It comes down to 3. So if you have a risk-reward, if you strictly follow a risk-reward ratio of 1:2, even if 3 out of your 10 ideas work,
Sure.
maybe 4, including the charges and everything, but even if that happens, you're still making money, which means you're limiting the downside impact, letting your stocks, ideas, portfolios run the profit, and despite being wrong more than half of the times, you're still making money. So the idea is not to limit the number of mistakes that you make. While it's a good idea to have, you may not be able to do that because even in a constantly evolving philosophy, you will find areas which work and then areas which really don't, and then you keep weeding them out, right? It's about limiting the impact of the downside. Also, now to answer your question, which is, how do you limit the number of mistakes that you make, is by starting out with a plan.
Okay.
Right? See what works, keep that, and weed out the rest. If I again bring this in the context of trading specifically, and even more specifically derivatives trading, what I fail to understand is why don't a lot of traders look at their last 3, 6, 12 month P&L and see whether it's really working for them or not.
Okay, I've got another question then. For somebody who's starting out, and I have incidentally, in the newsroom itself, we have somebody who is talking about their son who's 14 years old, who's interested in trading, and they were asking their mother for money so that they can buy X stock, right? And what they were asking was advice. How do I get my kid to learn this? Do you think a black book works? Do you think maintaining a record of things that you might have bought at the levels that you might have sold at, executing that, doing that for a period of a couple of weeks or a month and identifying your strike rate, do you think that that works, or is it that you really need to put the money down?
It helps for sure.
To put the money down?
No, the mock trading part.
The mock trading.
The black book, the black book that you said is more of mock trading. There are enough and more tools right now out in the market that will help you do mock trades.
Yes.
Key in the price, maintain your portfolio, see how it fares, all of that, right? Yeah. But somewhere I think this is like learning how to swim.
Yes.
I mean, you could take all the classes and you can have all.
Just jump in.
Eventually you'll have to jump in, and that's when you'll realize that despite being right, okay, in the blank book or the mock trading portfolio, things are very different here. In fact, that is true for a lot of back-tested data as well. Back-tested data looks fabulous, but the moment you start implementing that, things go for a toss and you have to then, adjust. So my idea is that it's not a bad idea to start with a plan, but be aware that it'll be very different. And you know what the primary reason for that will be, Alex? It'll be the emotions involved. The moment you get
actual money down.
Money down, that's when how you behave and how you react is very different. In fact, in your earlier question, when you asked me what was, one of the mistakes or some of the key mistakes, is not realizing the emotional biases that exist. And this is a very individual thing. While I can give you a lot of scientific or portfolio rules to play with, based on numbers, what works for you and how you react to trading losses and trading highs is very different to how someone else will.
I think it's been a fabulous conversation. Kush, thanks so much for taking the time for speaking to us on MoneyWise.
Pleasure's all mine.
That brings us to the end of this edition of MoneyWise. Hopefully it's been beneficial for you. Do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.